Hi, everyone, and thanks for joining us for another exciting Alpha Call. We are excited to be welcoming Chris Gunster, partner and head of fixed income at Fidelis Capital, and excited to share some quality insight into the fixed income space, make fixed income a little more exciting, which is great. Before we jump in, a good reminder to ask questions if you have them and give this video a thumbs up. It lets us know that you are out there. We see the numbers when we're doing the lives, but it's great to see the people as well. So with all that out of the way, Chris, thanks so much for joining. Really appreciate it. How are you doing? How's your day so far?
I'm good. Thanks for having me. Great to be here. Great time to be talking about fixed income as well.
No kidding. Definitely an exciting time. So really appreciate you taking the time. I figured since, it's your first time on the show, before we jump into anything directly, anything kind of additional to share kind of about yourself, your background for the audience before we jump in?
Yeah. So let me just share a couple of things. Look, I am head of fixed income for Fidelis Capital. For those that don't know about Fidelis Capital, we are an advisor-owned wealth management firm. And our goal really is quite simple, right? We work with very successful people and we try to simplify their lives. We try to give them back their time, whether it's investment management or planning or handling life events. That's what our goal is. And I am so pleased to be part of that group as head of fixed income. Just to give you a little bit of background about myself. So I have well over 30 years experience managing fixed income. The gray hairs will attest to that. We seem to be going from crisis to crisis these days. Most recently, well over a decade as head of fixed income portfolio management for a very large national bank. But I'm very excited to be here, talk about fixed income. Things have changed. Markets are dynamic. It's a great place to be here. And it's a great time to be talking about fixed income.
Amazing. Definitely. Again, thanks for sharing that background. And yeah, let's just jump straight in. I think to start, like you mentioned, fixed income investors have definitely had a rough couple of years. Can you kind of walk us through what's happened and why things you're saying are a little bit different now? What sort of changed?
Yeah, sure. So let's go back. Let's jump in our Wayback Machine and go back. And like I said, it's like we've been going from crisis to crisis. We've been handling the great financial crisis, COVID, issue around regional banks. And as a result of all of these events, the net result from global central banks was to squash interest rate, put interest rates down as low as possible. And I get it. That's understandable. But now that we have worked ourselves through some of these bad times, it's now now is the time to really reap some of the gains from the pains that we have felt. So let's go back just a little bit in terms of detail. Look, if I go back over the last couple of years, and the big event was really 2022. Where the Fed started increasing interest rates from the floor in reaction to the COVID crisis in order to stem rising inflation. And as a result, we saw some really rough times in fixed income. If I use the Bloomberg Aggregate Index, which is a measure of pretty much all the taxable securities out there, that was down 13% in 2022. And then 2023, we rebounded a little bit. 2024, kind of plus or minus in terms of returns. But where we are now is a great place. Going back, and if I look at where yields were over the last decade, the average yield on the 10-year Treasury, and we'll use that as a proxy for the bond market, was 2.5%. Inflation was running higher over that time period than 2.5%. So when I talk about being a very difficult time period, that's a great example of kind of the lost decade, if you will, that we faced within fixed income. But now, Mackenzie, things are looking brighter than ever.
I love to see it. It's good to have some sunny days return, which is fantastic. So in general, you're saying, maybe a time to look at bonds, getting a little bit more excited about that. Any other specific things that you'd point to that sort of really, juice that story?
Yeah, absolutely. All right. So when I came in this morning, 4.45% on 10-year Treasury. As I mentioned, the average over the last decade was 2.5. That's great. But we also need to look at it in terms of real rates. That is, what is the average rate after inflation? And when I'm looking at that currently, taking market expectations for inflation into account, the real rate of a 10-year treasury is a positive 2%. Compare that to the last decade, real rate expectations were 50 basis points. We're well over 150 basis points more in real rates, stuff you get to keep at the end of the day. And that's very exciting from an absolute standpoint. In addition, there are other factors that I'm looking at that make bonds very exciting. Number one, well, actually, this would be number three. The inverted yield curve is no more. What do I mean by inverted yield curve? Look, for the last couple of years or so, you got paid to hold short-term treasuries, cash, more than you got paid to own a 5-year or a 10-year treasury. Well, it seems to me, if I'm going to loan the government money for 5 years, I want to get paid more than just holding in cash. But that hasn't been the case, frankly, because of front-end rates and the Fed keeping rates higher. But now we are in a more normal curve where you actually get paid for going farther, for taking more risk. And that's a good thing. And it certainly helps. It reduces the confusion that investors have had. Do I go long? Do I go short? Now it's becoming more clear, and planning and managing fixed income is a whole lot easier when you have a normal shaped yield curve as opposed to an inverted yield curve. Mm-hmm. And within fixed income, there's a number of different sectors that we really like. And now all of the numbers that I have been talking about have been about treasuries. But if you look at things like corporate bonds, very attractive. Yes, I know you'll hear people say corporate bonds are expensive, and I don't get paid as much as I did in the past for taking additional risk over treasury, but who's denying the yields here, right? 70, 80 basis points more than the attractive rates on top of treasuries that I mentioned. That's a great place to be. When you're buying corporate bonds, you have to be a little bit concerned about default rates. And if I look at where expectations are for default rates, they're going to continue to remain stable, if not lower. And that's coming from S&P Global in looking at their expectations for defaults. So we're good there. And as well as the fact that you're getting that additional yield, taking that risk. So we like corporate bonds. We like treasuries. We like municipal bonds as well. Look, when we came into the middle of last year and there was concerns around the change in administration and the election, municipal issuers issued a ton of bonds. And that's good for investors because yields rose relative to other sectors. If I look at where municipal bond yields are right now on an after-tax basis, and I'm assuming a very high tax rate, most of our clients are in the top marginal bracket, you're looking at tax equivalent yields, what you would have to get in the taxable market, of somewhere between 5 and 6% for high quality investment grade municipal bonds. All of these yields that I'm talking about, whether it's corporates or munis or even high yield bonds, which we do like to a certain extent, are now at levels that we haven't seen in a very, very long time. So that's why I'm so excited about fixed income. And all of that gives us a yield cushion. So think about this. If you're buying a corporate bond or a treasury bond or anything with a higher yield, I'm earning more now than I had been in the past. So when I think about return being both yield and price, if price moves negative, I have a much higher yield cushion by buying bonds than I had in the past. If you go back to when rates were zero, I had no cushion. And as a result, returns were basically price return and market return, and that was a lot more volatile than it should have been. But now I've got that yield cushion. I've got now an instrument now that is much more stable in terms of total return. And so those are the number of reasons why I really think it's a great time for fixed income.
Yeah, that's a great lay of the land, I think, across, a ton of different types of bonds. And, it's gotten me excited about bonds. So I'm sure that for people out there watching, I hope so too. Well, then just kind of taking a look at how things have gone, of course, definitely want to focus in on just kind of the Fed's role in all of this when it comes to fixed income. What's your take on how they've handled things so far? What's their current role? What's your thought there, how it applies?
Yeah, absolutely. You can't talk about bonds if you don't talk about the Fed. So first of all, I think the Fed got a bad rap. Look, they got us through the COVID crisis. They may have put a little bit too much out there, and as a result, it ended up being higher inflation than we expected coming out of the COVID crisis. But all in all, I think they've done a very good job. Just a couple of years ago, there was a lot of talk about recession, hard landing versus soft landing. Well, guess what? We're still kicking, and it's doing quite well. Now, again, it's all about, hey, what have you done for me recently? Or more importantly, what are you going to do for me in the future? So if I look at kind of where the Fed is right now and where the market expects the Fed to go, we're looking for another 50 basis point cut in the Fed funds rate between now and the end of the year. So what that means is that puts the Fed funds target between 375 and 4, possibly at the end of the year. And that's a good thing, right? In my opinion, even at that level, they're still restrictive. If you think about the Fed's target goal for inflation of 2%, and we're still significantly above that, then over the long term, that Fed funds rate has to come down if the Fed is successful in controlling inflation. So more to come on that. But right now, I think the Fed is in a good place. They will continue to ease marginally, but there may be some other issues out there in terms of tariffs and taxes.
Yeah, let's definitely talk about that because I feel like that has been a big element as of late. So let's kind of get into the fiscal policy side of things. Speaking to tariffs and kind of taxes, how does that impact the bond market?
Yeah, and we've certainly seen volatility in the marketplace just in the last week or so. So think about this. Let's take tariffs first. The threat of tariffs increases volatility and increases market expectations for future inflation. The actual tariffs will cause inflation, at least in the short term. What we have seen just in the last week is a combination of both, right? The threat, more important, probably more dramatic than the actual implementation of tariffs. So I think we have to take that with a grain of salt and be a little bit flexible and see how that works out. What we can do is we can go out in the marketplace and derive an inflation expectation from market participants and see what has changed. And what you'll see is that market participants now are expecting, and the number is 2.6%, an implied inflation rate over the next 5 years. Put that into historical context. That's the highest we've been in 3 years. Okay, so the market is getting a sense that there may be inflation coming down the pike. It seems to be relatively under control for now. 2.6, not so bad, but it's something that we need to watch. But more importantly, how does the threat of tariffs and tariffs impact what the Fed may or may not do? So the Fed is not going to come out and say that the administration's policies are inflationary and this is what we have to do. What they will do is they will react when the numbers and the inflation expectations start to print. And that's what we're going to see, right? If the Fed believes that by looking at the data that inflation is on the rise, well, then they may take some of those cuts off the table. They have pared back some of the, or at least the market has pared back some of the Fed's expectations for Fed rate cuts. Just a couple of months ago, we were looking at another 2 cuts for 2025. They pared that back now to, instead of 4, now to 2. So we've seen the effects of tariffs and we've seen the market reaction. We know what is priced in right now in tariffs. And what that means is that at the margin, we could see a trend higher in interest rates, particularly on the back end, assuming no increase in demand. And I'll get to that in just a minute. All right, so we have tariffs that are explicitly sort of pushing rates higher as we go forward in time. And then we have taxes. very simply, right? You have to pay for tax cuts, and it can come from two sources. You can either cut your spending or you can issue more debt. I'm in the camp, and the firm is in the camp, that there will be more debt, more Treasury debt coming down the pipe.
Yep.
Well, we're already sort of in a jam when it comes to Treasury debt. Our debt to GDP right now is 1.23% of GDP. That's relatively high. Before the administration's policies, or before the new administration came into play, we were looking at a trend higher in debt to GDP. $35 trillion is the amount of debt we have now. There were expectations of that increasing to 52 trillion by the end of 2033, and that's before the new administration. So there is a concern right now that we're going to have more debt. And what does that mean? That means more supply in treasuries, at all things being same, are going to push yields higher across the curve. Now, that being said, that's on the supply side. But, given all these uncertainties, Mackenzie, both in tariffs and taxes, inflation, I am still optimistic on bonds. Why? Okay. All of the effects that I'm talking about really is about the U.S. Treasury market. The U.S. Treasury market is the biggest, most liquid market in the world. All right. So where do people go when the stuff hits the fan? They go to the Treasury market. So we have that going for us. Foreign assets continue to flow into Treasuries. And I'm talking about the demand side now, right? We have seen over the last decade an increase by almost every single country except for China, which is flat to coming back down now, increasing their demand for Treasury assets. In addition, if you look at where yields are globally, you'll see the U.S. is here. The rest of the developed world is here. What does that mean? That means if you're sitting in Germany and you want to put your money to work, you can get a higher yield by buying dollars, converting those to treasuries. So, all is not lost in terms of what I talked about in terms of tariffs and taxes on the supply side, because there is demand. And then one more thing, I have another 7 trillion reasons why I like fixed income. There's $7 trillion in money market funds sitting there. Right now, it's probably earning somewhere around 4%. Okay, if the Fed continues to cut another 50 basis points, you're talking 3.5% on those assets. I think at that point, those investors in money markets should probably take a step back and say, how can I earn additional yield without taking so much more risk? And the answer is fixed income. The answer is bonds. The answer is treasuries. The answer is corporate bonds. The answer is municipal bonds. All of those should be considered. If you're sitting in a money market and you're starting to see your yields decline, you should be stepping out. And I do believe that as we move through 2025 and rates come down in the front end, you're going to start to see more flows out of that 7 trillion and into high quality bonds.
Yeah, I think that totally makes sense. I think, again, very, very well laid out. And I can see the reasons for your optimism around kind of fixed income. Just to kind of balance it out a little bit, is there anything that kind of gives you a little hesitation? Anything that makes you think, I'm a little worried potentially? Anything that's kind of on that horizon as well?
Yeah, certainly. Absolutely. There's always that. Look, we've started to see a de-escalation of, global conflicts. Great. However, global conflicts are inflationary. And that's a concern of mine. That could heat back up. Secondarily is the administration's the unknown administration fiscal policies. What could that lead to? There is a concern that there is some unknown policies that may hit the market out there. But, we have to take that with a grain of salt. We can only deal with what we know. And so far, some of the policies that have been put forward, the market has been able to handle quite well, be able to understand what the impact is and move forward. And then finally, my last concern is really sort of a political concern around fixed income bond ratings. So as you know, and for those of you who don't know, the S&P in 2011 downgraded U.S. Treasuries from their AAA rated status to AA plus, and then Fitch followed a couple of years after, doing the same sort of thing. Moody's still holds a AAA rating on U.S. Treasuries. Before the administration came in, I was expecting this year to have Moody's join the club and downgrade U.S. Treasuries to AA plus. I believe that's still going to happen. But now, really, what's the implications? The implications to the market will probably be fairly minor, because I think a lot of other folks are thinking the same way. And if I look at the reaction to marketplaces when Fitch did it, and when, well, maybe not so much S&P, but certainly when Fitch did it, there was some short-term volatility, but it all sort of went away. The concern really in the downgrade from AAA rated status by Moody's is really a political shot across the bow, and less a market map. It could manifest itself into higher volatility, but nonetheless, it's something that I'm looking forward, a concern about, but I don't think it's going to be that onerous to financial markets. And I say that so that the viewers here can understand and expect that, and not go willy-nilly once it occurs.
Not to react to the headline emotionally. I think that makes sense. So for that downgrade, do you think it's sort of one of those things that the impact will be felt less heavily because it's happened before? So it's sort of not old news, but again, kind of has happened before. It's not a new thing. Or do you think it's one of those things where it's sort of building momentum? It feels like a mounting problem to people. What's sort of the perception there?
Yeah, it's both of those, right? People are getting used to it, the potential for that to happen, as well as history suggests that it won't be that onerous. And let's not forget, point number one, when I talked about U.S. Treasury market, it is the largest, deepest market in the world, and the U.S. dollar is the reserve currency. So to the extent that there is uncertainty around that, where are you going to go? We are the tops.
Yeah, the most attractive. I think that makes sense. All right, fair enough. All right, well, so I feel like you've laid out a great sort of case for fixed income itself, but in terms of, translating that into action and actually having investors navigate the market, how would you kind of walk people through how to actually access it and navigate it?
Yeah, great question. So think about this, right? We are at Fidelis Capital strong advocates of active management, both in bonds and outside of bonds, and equities and other assets. I think especially in the fixed income market, if you're going to succeed in the volatile marketplace that we are now, you need to have an active approach. Let me put it into perspective here, just kind of my concerns around passive indexing bond investment. And granted, it's not for everybody, active management. If you like your passive index investing, that's great. But you need to do a couple of things. Number one, you need to know the index in which the ETF or fund or SMA is trying to duplicate. And let me give you a concern of mine. So the largest, as I mentioned, the largest fixed income index out there on the taxable side is the Bloomberg Aggregate Bond Index. And it contains everything that's taxable: treasuries, corporates, mortgage-backed securities, asset-backed securities, commercial mortgage-backed securities. Okay. That particular index has gone through some pretty substantial changes over the years. And if you didn't know any better, and if you didn't dive into the details, you'd say, okay, that's a great proxy for the bond market. And it is. But that bond index right now contains roughly 48% U.S. Treasuries. That's a high allocation, the way I look at it, to a very conservative asset class. And in addition to all of the things that I talked about in increasing debt, that amount's only going to increase. So to the extent that you are using a passive index, know your index. Is a 50 or higher percent allocation to treasuries fit your risk goals, your risk parameters, your goals? That's what needs to be, that's what you need to understand. And in addition to that, there's always the dynamic between who's better, active or passive. Morningstar puts out a active passive scorecard. And at least on the fixed income side, over time, active management has proven to outperform passive, including any of the fees that are associated with their universe. So I'm very pleased about that particular. Look, there are plenty of active ETFs out there. There are plenty of active mutual funds and SMAs that, if you do the homework, you can find good managers that are well worth their price. And certainly, we believe we are on the SMA side.
I definitely agree. And, you're speaking our language on the active element. I think, again, being able to find those managers that can, perform better over time is definitely a story that rings with us, I think is great. Can you take us through in a little more detail, sort of how you're approaching in those, SMAs, how you're taking that active approach? Can you kind of walk us through a little bit?
Yeah, so how we're positioned now with regard to all of the uncertainty that I mentioned, as well as the fact that we like fixed income. We want to remain sort of in a high quality bias. Well, what does that mean? That means in the municipal space, we're avoiding BBB rated securities. Granted, there's not a lot out there anyway, but frankly, I think we believe that you can get enough yield and enough total return from staying in higher quality in both the municipal space and the corporate space. Now, within the corporate space, we do like some BBBs. But in general, you want to remain higher in quality. That doesn't mean we don't like high yield. We do. We just want to avoid bonds that may be downgraded, and we don't think there's a big risk of it, but you just want to stay away from it anyway, because frankly, we're getting enough yield from the investment grade space and a little bit on the high yield space to make things very attractive. Given all the volatility that I also talked about, it's very important that you do the right security selection, and particularly around tariffs, right? There will be winners, there will be losers in both industry and within industries, certain corporations, certain sectors that you have to pay attention to. So security selection now is very important to navigate high quality, navigate the high volatility that's in the marketplace. The other thing I would say is I talked about the steepness of the yield curve. You get paid to take additional maturity risk in treasuries, in corporates, and in munis. Don't be afraid to do so. Capture that yield. Remember, the bigger that yield cushion that you build in portfolios, the more stability and the more return you'll have over time. So we like that. And then, of course, our number one thing that you should always remember when it comes to active fixed income management, in fact, active management in general, is flexibility. Remember that uncertainty leads to volatility. Volatility breeds opportunity. And the only way that you can generate positive alpha off of these opportunities is to have the flexibility, the nimbleness to be able to capitalize on those opportunities when they present themselves.
I think that's fantastic. And again, I think if the beginning of 2025 has taught us anything, there is probably more uncertainty to come, which means more volatility, which means more opportunity if managed appropriately. So that's fantastic. I feel like we've covered a ton. So just kind of wanted to kind of get a quick summary and kind of, tie it up in a bow before hitting the Q&A. But it sounds like ultimately fixed income, still attractive. People should not overlook it. I think it's one of those things that's important. But again, making sure you're taking the right approach. Does that basically capture it? Anything else to add?
Mackenzie, look, fixed income is sexy again.
I love it.
Taylor Swift, the Kelsey brothers, yeah, they're popular. Yeah, but you know what? Give it time. Fixed income, we are right behind them.
There you go. I love it. That's awesome. I will also say I love the Eagles flag in the background, which I know is sort of the opposite, which is good, but also go Birds. All right, I'm seeing, that's fair. Who cares? I'm seeing two questions. One is asking, what's your take on the 60-40? Is it outdated? What's your thought there?
Well, look, 60-40 is a general rule of thumb that folks use for portfolio management. We prefer to take a more customized approach. Every single client is different. You need to understand both the goals, the risk, and more importantly, in this environment, what's the taxes? Look, when I talk to clients, they can tell me their goals and we can talk about risk profile. But one of the things that their other managers have refused to sort of work into the conversation is taxes. And that's really important. And that's regardless of whether you're talking about fixed income or equities. It's very important that you do that. And then you derive that asset allocation based off of all of those metrics. So 60-40, it's fine, but there are other asset class that 60-40 doesn't include, and it should be more customized to the particular client that you're investing for.
I think that makes sense. Again, getting that kind of tailored suit rather than off the rack in terms
Absolutely.
of that makes sense. All right, next question, which is from Stevie. Thank you so much, Stevie. Does crypto like Bitcoin have any effect on your business? It's always
well, we're currently evaluating kind of where crypto fits into the whole asset allocation. It's certainly something that we can't sort of deny that is happening. There's certainly a lot of volatility around that. The way that we're kind of looking at it, there might be a place for assets like that in the portfolio. It gets a little difficult in terms of figuring out what the allocation should be. But again, back to understanding the client. If the client understands the risk that they're taking in crypto and other assets like that, then certainly it's something that we should be adding to that portfolio once the client understands the risk profiles around that.
I think that totally makes sense. Again, just knowing what you own is the key, most important part.
Absolutely.
All right. Fantastic. Thank you so much for your time, Chris. This has been so insightful. I'm so fired up about fixed income now, which is awesome. Would love to just say, as we're closing towards the end, how can people kind of stay up to date with you, your insight, everything kind of going on?
Yeah, so you can reach out to me on LinkedIn, where we do a lot of posting. And you can also go to Fidelis Capital, our website, and find a plethora of information there that describes our process, our detail, our passion, even better than I have.
Fantastic. You've done a great job. Thank you so much, Chris. Thanks everyone for being out there. Really, really appreciate it. And we hope to catch you next time. Thanks so much.
Great. Thank you.
Before investing, carefully consider the investment objectives, risks, charges, and expenses found in the prospectus, available at AdvisorShares.com.